So thank you for joining us again, captains of industry, at this maiden post MPC meeting with CEOs of banks. This is the first under my tenure as governor, and I'm happy to interact with you all at the start of my journey. Now, these engagements with you are central to ensuring a mutual understanding of policy direction and alignment in our collective efforts to foster macroeconomic stability and recovery. Colleagues, as captains of industry, I want to acknowledge the journey that we all have traveled in recent years. The last few years especially have tested the resilience of our financial system, from the banking sector cleanup to the Domestic Debt Exchange Program, or DDEP. Colleagues, I do recognize that these events have had deep operational, financial, and reputational consequences for banks. And I want to commend you for the strength, your professionalism, and commitment with which you have navigated these storms. Many of the fallouts could have been mitigated had the cleanup been more balanced and consultative. And the DDEP, too, could perhaps have been avoided entirely with earlier coordination and foresight. Now, we cannot change the past, colleagues, but we can learn from it. And it is my intention to build forward with greater collaboration, trust, and accountability between the Central Bank and all of you. Let me now turn to the policy decision taken by the Monetary Policy Committee at its most recent meeting, which was the 123rd. As you are all aware, the committee, by a majority decision, raised the policy rate by 100 basis points to 28%. This decision was aimed at reinforcing the disinflation process, which, while underway, remains too gradual to secure lasting stability. The decline in headline inflation from 23.8% in December to 22.4% in March confirms that recent policy actions are having the intended effect. However, inflation expectations remain elevated and core inflation is still above the medium-term target. Now, with private sector credit and broad money supply expanding, demand-side pressures could re-emerge without continued vigilance. The committee therefore adopted a proactive stance, guided by recent experience that delayed tightening can result in more persistent inflation and costlier adjustments. The policy rate increase also strengthens external buffers. It supports the cedi and signals our commitment to macroeconomic stability at a time of heightened global uncertainty. Colleagues, we also recognize that the policy rate hike will affect borrowing costs for businesses and households. While the policy tightening will affect funding costs and credit pricing in the near term, the financial system is well positioned to absorb these effects. We therefore want to urge banks to exercise prudence in adjusting lending rates and maintain transparent communication with your clients. Viable businesses should continue to receive support, and tailored solutions should be explored to mitigate the impact on the most vulnerable sectors. On the outlook for the banking sector, let me outline how the banking sector is positioned to support recovery and resilience. Overall, colleagues, we continue to witness broad-based improvement in financial stability, though we remain keenly aware that persistent challenges require our continued and focused efforts. The recent gains in macroeconomic stability following the Domestic Debt Exchange Program, the improved profitability of banks, and the structural high liquidity and continuing recapitalization are improving the soundness in the banking sector. Even without recent reliefs, the banking sector soundness indicator showed sustained improvement on the back of improving solvency and asset quality measures amid strong liquidity and profitability. The banking sector continues to experience strong asset growth, expanding by 34.05% year-on-year at end February 2025. And this was funded primarily by deposits, which also grew by 27.9%. The industry remains solvent, recording a capital adequacy ratio of 14.35%, above the regulatory minimum of 10%, with most banks maintaining capital adequacy ratios above thresholds. Nonetheless, colleagues, solvency concerns persist for a few domestically controlled and state-owned banks, where recapitalization efforts remain unclear. Addressing the capital shortfalls in these banks remains a priority going forward. We are working closely with the affected institutions to achieve sustainable capital levels, restore depositor confidence, and ensure compliance with regulatory requirements. Colleagues, our supervisory engagement has intensified to assess the credibility of recapitalization strategies and to mitigate potential systemic implications. Private sector credit is also recovering, but credit risk remains elevated. Non-performing loans have risen, largely due to growth in legacy exposures, as the NPL ratio stood at about 22.6% as at February 2025. Excluding the fully provisioned loss category loans, the adjusted NPL ratio was 8.9%. And let me say that we'll be embarking on a special exercise to address these issues. This trend reflects ongoing deficiencies in credit risk management practices, including weak underwriting standards and inadequate provisioning. To address rising credit risks, we want to urge all banks to strengthen their risk management frameworks, to improve underwriting, their early warning systems, and provisioning practices. We expect tangible improvements in loan origination, in monitoring, and credit review. Colleagues, the financial landscape is evolving rapidly. We have fintechs and non-traditional players introducing both opportunities and risks. While many operate under lighter regulatory regimes, banks must respond with innovation, with agility, and a sharper focus on customer-centric services. We want to encourage strategic partnerships, digital transformation, and product innovation, while the Bank of Ghana deepens its engagement with non-bank financial service providers to ensure innovation thrives within a stable, well-supervised ecosystem that supports financial inclusion and protects consumers. Colleagues, as digitalization and financial interconnectedness deepen, new operational and systemic risks are emerging. While banks have made progress on cyber resilience, the evolving nature of fraud and financial crime demands continued vigilance going forward. We want to urge all banks to strengthen internal controls and enhance oversight of operational areas to stem this trend. The responsibility for securing banking products and services must fall more squarely on institutions than on the average customer. The average customer who relies on the integrity of systems and on due diligence. The Bank of Ghana's Information Security Office continues to share real-time threat alerts, and institutions are expected to act swiftly under the Cybersecurity Directive. We take cyber threats seriously, and we urge all financial institutions to match that level of commitment. Colleagues, let me also take advantage of this gathering to emphasize the need for unwavering vigilance and full compliance with AML obligations. As we enter the third round of mutual evaluation by GIABA, and this is happening next year, our collective goal must be a first-time success. Colleagues, history shows we've struggled in past rounds, and we cannot afford to be green-listed again, especially given the outsized impact that reputational and financial penalties would have on the banking sector. Lessons from past bank resolutions continue to shape our crisis preparedness. We are refining our supervisory and resolution tools, including work to strengthen recovery planning and introduce a resolvability assessment framework. These are to ensure that banks are both well capitalized and resolvable in distress, especially in an increasingly interconnected system. Colleagues, as we deepen reforms and reposition the financial sector for the future, it is equally important to reflect on how banks can do more to drive Ghana's economic transformation. Colleagues, one critical area is trade facilitation and regional integration. We expect stronger support, especially from the foreign-owned banks, in terms of trade financing, cross-border payment infrastructure, but also platforms like the PAPs that have become available in recent times. And I've had the opportunity to discuss this point with a number of colleagues in the industry. I illustrated the case where you have payments coming in from Nigeria, but then also payments going to Nigeria from Ghana. Why do we have to go through the dollar for each and every one of those transactions? There should be a way we can achieve a net settlement which will have a beneficial impact on our cash flows. The same thing if you look at the flows between Ghana and South Africa. We have payments that are going to South Africa, but then also payments that are coming in from South Africa. Do we have to go through the dollar for each of those transactions? I want to leave this with you as we think through together the future of our industry. Colleagues, to build true resilience going forward, we want to move decisively, and I emphasize the word decisively. We want to move beyond the traditional reactive supervision, and we want to move towards a more forward-looking, a more risk-sensitive, and system-aware model. This shift is not just about enforcing compliance. It is about shaping a banking system that is agile, a banking system that is accountable, and a banking system that is prepared for the future. Our strategy is anchored in a few key areas, and permit me to outline them. The first one is on risk identification and mitigation. Under this, we are enhancing our use of data analytics and early warning indicators to identify emerging risks, whether in asset quality, whether in cybersecurity, fraud, liquidity, or systemic buildup of non-performing loans. For example, the 2024 fraud report revealed a 5% increase in fraud cases and a 13% rise in value at risk, reinforcing the urgency of stronger internal controls and oversight. The next focus will be to build digital resilience in all that we do. Colleagues, we welcome digital innovation. But this must be pursued with discipline and matched by robust cybersecurity, operational resilience, and governance. Banks must assume greater responsibility for the safety of their systems, for product integrity, and for customer protection. Accordingly, we expect banks to invest significantly in product security features, expand public financial education, and alert customers swiftly on emerging fraud typologies. Institutions are expected to act swiftly under our cybersecurity directive. Over last weekend, I was having a conversation with my counterpart in Nigeria, and one of the things I was happy to hear is that in their system, if any of your staff enters the account of a client, there's an alert to the customer. Do we have the same thing in place in Ghana? Can we have that in place in Ghana? Colleagues, the third area of focus is governance and compliance. And as you know, sustainable banking requires strong governance at the core. Ethical lapses and weak internal controls are not isolated risks. They have systemic consequences. We are deepening our supervisory focus, therefore, on board effectiveness, on compliance culture, and accountability across all levels of institutions. Compulsory Basel II and IV training will be put in place for all bank directors, and this is to enhance regulatory knowledge and governance among bank directors, and these are under consideration. The fourth area is to enhance collaboration among ourselves. As you know, effective regulation cannot be unidirectional. We are committed to an open, collaborative dialogue with banks and policymakers to ensure that regulatory responses are well informed, proportionate, and responsive to the realities of the market. We must co-create solutions, not merely to enforce rules as we have currently. The fifth focus is to build capacity for future challenges. We recognize that the future will bring unfamiliar risks. For example, AI in finance, climate shocks, geopolitical volatility, among others. These shocks will emerge, and that is why we are investing in upskilling our supervisory teams to be able to match the pace of innovation and complexity. This is about future-proofing our regulatory capabilities. Lastly, colleagues, we will prioritize sustainability oversight, and that has to do with ESG and climate-related risks, which are now part of our on-site examinations. These are not peripheral issues. They directly influence credit risk, they influence reputational exposure, and they influence long-term viability of your institutions. Our findings will shape supervisory expectations and help drive a transition toward more responsible, sustainability-conscious lending practices. Colleagues, the area of backward-looking supervision is effectively over. What lies ahead demands that we reframe our mindset, not just to comply with the present, but to shape the future. Resilience will depend not on avoiding risk altogether, but on managing it wisely, transparently, and in alignment with broader economic and environmental goals. Before I conclude, ladies and gentlemen, let me offer a broader reflection on the moment we are in and the road ahead for our financial system. Colleagues, financial institutions, as you know, like yours, are essential to Ghana's economic growth. You don't just allocate capital and manage risk. You directly impact lives and the lives of Ghanaians. We're talking about the smallholder farmer, who is assessing a seasonal loan, or you're talking about the SME expanding operations, or you are even talking about the graduate who is opening their first bank account. The trust you build shapes livelihoods. This is serious business. Despite the shocks of the financial sector cleanup and the DDEP, our banks have shown resilience. While capital markets are still regaining traction, your efforts have been central to maintaining financial stability. And let me once again commend your dedication through these challenges. But the landscape continues to shift. As you know, technology, evolving customer expectations, and regulatory demands require us to adapt boldly. And together, we must rebuild confidence and position the sector to support inclusive growth. As we begin this next chapter under my tenure, let us renew our shared commitment to a stable, to an inclusive, and to an innovative financial system. A financial system that safeguards the most vulnerable, embraces responsible technology, and expands access across geography and incomes. Financial inclusion, as they say, isn't just a goal, it is a necessity. As regulators, the Bank of Ghana stands ready to support you through policy, through dialogue, and through collaboration. And our aim is to build a system that truly serves our people and supports the long-term growth. Looking ahead, as we continue this path of recovery and reform, it is essential that our immediate actions, like the recent policy decision, remain anchored in a clear long-term vision. Colleagues, during my swearing in, I outlined 6 priorities, as some of you remember, and we remain committed to the achievement of those 6 priorities. First one is to strengthen monetary policy implementation, and you can see some signs of that already. We want to preserve exchange rate stability, and I'm sure you have seen some signs of that as well. We want to deepen financial intermediation, and you will be seeing signs of that going forward. We want to advance innovation and inclusion, and we want to improve coordination while safeguarding our independence and restoring the bank's equity position. These priorities, colleagues, will continue to guide our path. And with your partnership, I am confident that we will deliver a stronger, a more resilient, and inclusive financial system for all Ghanaians. I thank you for your attention.